Hello, welcome to Capital Sensei. Today, we're gonna dive deep into what is arguably the most important book ever written on investing. I'm talking about The Intelligent Investor by the legendary Benjamin Graham. We'll unpack his core philosophy, distinguishing a true investor from a speculator. We'll meet his most famous creation, the allegorical Mr. Market, and understand how to use his mood swings to our advantage. And most importantly, we'll explore the central concept that protects your capital, the margin of safety. Whenever we can, we try to answer questions left in the comments. So as we go through this, if anything sparks a question, a doubt, or even if you have a story about your own investment journey, please share it below. Your experiences help everyone else learn, and together we can build a really strong community of informed people. So, let's start with the man himself, Benjamin Graham. Why should we listen to a guy who wrote a book that was first published back in 1949? Well, for one, he's widely considered the father of value investing. He lived and invested through the Roaring '20s, the catastrophic crash of 1929, and the Great Depression that followed. This experience forged his entire philosophy, which is built not on chasing wild profits, but on the disciplined preservation of your hard-earned money. And if that isn't enough, he was the professor and eventual boss of a young man you might have heard of, Warren Buffett. Buffett has repeatedly called The Intelligent Investor the best book on investing ever written. He says picking up this book was one of the luckiest moments of his life. So, when someone of Buffett's stature gives that kind of praise, it's probably a good idea to pay attention. The first, and perhaps most critical, distinction Graham makes is between an investor and a speculator. This isn't just semantics, it's the foundation of his entire framework. He gives a very precise definition. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Let's break that down. Thorough analysis means you've done your homework. You're not just buying a stock because the ticker symbol is cool or because your cousin's friend said it's going to the moon. You've looked at the company's financial health, its management, its competitive position, and its long-term prospects. You are buying a business, not a lottery ticket. Safety of principal is the idea that you have a high probability of getting your initial investment back. This doesn't mean the stock price can't go down temporarily. It means the underlying business is so solid and you bought it at such a reasonable price that a permanent loss of capital is highly unlikely. And an adequate return means a reasonable, not an astronomical profit. Graham wasn't trying to teach you how to double your money overnight. He was teaching you how to achieve a satisfactory, business-like return over the long haul. Something that will consistently build your wealth without exposing you to catastrophic risk. Anything that doesn't meet all three of these criteria, in Graham's view, is speculation. Think of it like buying real estate. An investor buys a house in a stable neighborhood, calculates the potential rental income, subtracts expenses like taxes, insurance, and maintenance, and determines that the property will generate a positive cash flow. They're focused on the business of being a landlord. A speculator, on the other hand, might buy a condo in a super hot market with no intention of renting it out. They're just betting that someone else will be willing to pay more for it in a few months. Their profit depends entirely on the market's mood, not the underlying asset's productive capacity. Graham is clear that there's nothing inherently immoral about speculating, as long as you know that's what you're doing. The real danger comes when you think you're investing, but you're actually speculating. That's how people get wiped out. You must be honest with yourself about which game you're playing. This leads us to Graham's most brilliant and enduring creation, the allegory of Mr. Market. To really understand the psychology of investing, Gran asks you to imagine that you are in a business partnership with a man named Mr. Market. You own a piece of a private business, and every single day, without fail, Mr. Market shows up and offers to either buy your share or sell you his share. Now, here's the thing about your partner, Mr. Market. He's a bit unstable. He's a manic depressive. Some days, he's euphoric. He sees nothing but a bright, rosy future for your business. On these days, he'll quote you a ridiculously high price for your shares. He's practically begging to buy you out for far more than the business is actually worth. On other days, Mr. Market is inconsolably pessimistic. He's convinced the business is going bankrupt and the world is ending. On these days, he'll show up at your door, desperate to sell you his shares for pennies on the dollar. He's in a full-blown panic and just wants out at any price. Graham's genius was in this characterization. Mr. Market is the stock market. His daily quotes are the stock prices you see on the screen. The crucial insight is this: Mr. Market is there to serve you, not to guide you. You are under no obligation to trade with him. If you don't like his price today, you can just ignore him. He'll be back tomorrow with a new one. The mistake most people make is letting Mr. Market's mood dictate their own. When he's euphoric and prices are high, they feel euphoric and rush to buy. When he's panicking and prices are low, they panic and rush to sell. The intelligent investor does the exact opposite. They use his emotional swings to their advantage. The intelligent investor has already done their homework. They have their own independent idea of what the business is actually worth, what we call its intrinsic value. So, when Mr. Market shows up ecstatic and offers a crazy high price, the investor might consider selling their shares to him. And when Mr. Market shows up depressed and offers a ridiculously low price, the investor sees a wonderful opportunity to buy more of the business at a bargain. This single allegory perfectly encapsulates the discipline and emotional detachment required for successful investing. You don't ask the market what to do. You decide what the business is worth, and then you check to see if the market is offering you a price that makes sense. The market is a tool, not a guru. This naturally brings us to what Warren Buffett calls the 3 most important words in investing: margin of safety. This is the central concept of Graham's entire philosophy. It's the practical application of dealing with Mr. Market. It's your buffer against error, bad luck, or the wild swings of the economy. So what is it? A margin of safety is simply the difference between the fundamental or intrinsic value of a business and the price you pay for it. The wider this margin, the safer your investment. Let's use a non-financial analogy to make this crystal clear. Imagine you're an engineer building a bridge. Your calculations show that the bridge needs to be able to support a maximum load of 10 tons. Do you build the bridge to hold exactly 10 tons? Of course not. That would be incredibly reckless. What if your calculations were slightly off? What if a truck heavier than expected tries to cross? The bridge would collapse. Instead, a prudent engineer would build the bridge to support, say, 30 tons. That massive 20-ton cushion is the margin of safety. It protects you from errors in your own calculations and from unforeseen events. It ensures the bridge stands firm no matter what. Investing works the same way. Let's say, after doing your thorough analysis, you determine that a share of company XYZ is intrinsically worth $100. This is what you believe the piece of the business is truly worth based on its assets, earnings, and future prospects. Would you buy it if the market price is $95? According to Graham, absolutely not. Your margin of safety is too thin. The intelligent investor waits. They wait for Mr. Market to have one of his panic attacks. Maybe there's a market downturn or some bad news specific to the company's industry. Suddenly, Mr. Market is offering to sell you shares of company XYZ for $50. Now you have a $50 margin of safety. You are buying $1 of value for 50 cents. This large margin does two things. First, it provides you with a cushion against mistakes. Even if your intrinsic value calculation of $100 was a bit optimistic, and the company is really only worth, say, $80, you still bought it at $50. You're still in a great position. Second, it provides the potential for a much higher return. As the stock price eventually climbs back toward its true value of $100, you've doubled your money. Demanding a significant margin of safety is the ultimate defense. It's the part of the process that truly separates investing from speculating. It's how you ensure the safety of principle that Graham insisted upon. You are not trying to predict what the market will do. You are protecting yourself from its potential foolishness. Now, Graham understood that not everyone has the same amount of time, skill, or interest in doing this kind of deep analysis. So, he divided intelligent investors into two categories: the defensive investor and the enterprising investor. It's important to know which one you are. The defensive investor, also called the passive investor, has a primary goal of avoiding serious mistakes or losses. Their secondary goal is freedom from effort, annoyance, and the need to make frequent decisions. This is for the person who has a full-time job and a family and doesn't want to spend their weekends poring over financial statements. Graham's prescription for the defensive investor is beautifully simple. First, they should maintain a balanced portfolio, traditionally a 50-50 split between high-quality bonds and a diversified basket of stocks. This allocation acts as an automatic stabilizer. When stocks fall, the bonds provide a cushion. When stocks are soaring, you can rebalance by selling some stocks and buying more bonds, forcing you to sell high and buy low. For the stock portion, the defensive investor should stick to large, prominent, and conservatively financed corporations. We're talking about the blue-chip giants of the economy. He also suggested specific criteria, like a long history of continuous dividend payments, say, for at least 20 years, to prove their stability and financial discipline. The key is diversification. A defensive investor shouldn't own just 2 or 3 stocks, but a broad portfolio, perhaps 10 to 30 of these high-quality companies, or more simply today, a low-cost stock market index fund. The goal here is not to beat the market. The goal is to avoid being beaten by the market, and more importantly, by your own emotions. It's a strategy designed for safety, simplicity, and peace of mind. Then there's the enterprising investor, sometimes called the active or aggressive investor. This person is willing and able to devote more time and effort to their investment portfolio. They have a bit more knowledge, more experience, and crucially, the right temperament to seek out opportunities that the defensive investor would ignore. Their goal is to achieve a better than average return, but they understand this requires better than average work. The enterprising investor might look beyond the large blue-chip stocks. They might analyze smaller companies that are less followed by Wall Street analysts. They might look for what Graham called bargain issues, stocks that are trading for significantly less than their net working capital, which is like buying a company for less than the cash it has in the bank after paying all its debts. They might also engage in special situations like mergers, acquisitions, or corporate spin-offs, where there are predictable profits to be made for those who understand the mechanics of the deals. This is a much more demanding path. It requires more intellectual horsepower, more research, and a very steady hand. It's like the difference between driving a reliable family sedan and being a Formula One driver. Both can get you where you're going, but one requires a completely different level of skill and commitment. Graham warns that many people who think they are enterprising investors are really just speculators in disguise. They chase hot tips and complex strategies without putting in the real work. The true enterprising investor is just as disciplined and risk-averse as the defensive investor. They just apply that discipline to a wider and more complex field of opportunities. Beyond these broad strategies, Graham builds his philosophy on a few key pillars. One of the most important is the concept of the circle of competence. This is a simple but profound idea. You don't have to be an expert on every company in the stock market. In fact, trying to do so is a recipe for disaster. Instead, you need to honestly assess what you know and what you don't know. Draw a circle around the industries and businesses that you can genuinely understand. If you've worked in the software industry for 20 years, you probably have a deep understanding of how technology companies compete and create value. That's inside your circle. You might have no idea how to evaluate the reserves of an oil and gas exploration company. That's outside your circle. The intelligent investor rigidly stays within their circle of competence. Warren Buffett is famous for this. For decades, he avoided technology stocks because he said he didn't understand them. It wasn't about whether they were good or bad investments. It was about his own ability to judge them with confidence. The size of your circle is not important. What's vital is knowing where the perimeter is and staying inside it. Another pillar is, of course, diversification. Graham saw this as a basic, non-negotiable rule of prudent investing. There is a close logical connection between the concept of a safety margin and the principle of diversification, he wrote. Even if you buy every stock with a large margin of safety, you could still be wrong about one of them. A single company can suffer from fraud, a sudden technological disruption, or just plain bad management. If you have all your money in that one company, a mistake can be devastating. But if you own a portfolio of, say, 20 different companies, each bought with a margin of safety, the failure of one or two of them will not sink your entire portfolio. The successes of the others will more than compensate for the few duds. Diversification is your shield against the unpredictable nature of the future. It's the admission that even with the best analysis, you can't be right 100% of the time. Ultimately, what Graham is teaching is a business-like approach to owning stocks. He constantly urges the reader to forget that they are playing with flashing quotes on a screen, and to remember that a stock is not just a ticker symbol, it's an ownership stake in a real business. Before you buy any stock, you should ask yourself a simple question. Would I be willing to own this entire business outright at this price? If the answer is no, then why would you want to own a tiny piece of it? This mindset shift is transformative. It forces you to think about long-term business fundamentals, profitability, debt levels, competitive advantages, rather than short-term market sentiment. You become a business analyst, not a market timer. You focus on the performance of the company, not the gyrations of its stock price. Perhaps the most surprising and enduring lesson from the intelligent investor is that your success will depend far more on your character and temperament than on your intellect. Graham himself wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself. It's not about having a genius-level IQ or a PhD in finance. It's about having emotional discipline. Can you be greedy when others are fearful, and fearful when others are greedy? That's the famous Buffett quote, but it comes directly from the teachings of his mentor. Graham, can you patiently wait for the right pitch, the perfect opportunity with a wide margin of safety, even if it means doing nothing for months or even years? Most people can't. The urge to do something is overwhelming. Can you watch the value of your portfolio drop by 30% in a market crash and not panic sell at the bottom? Can you stick to your analysis and perhaps even buy more when everyone around you is screaming that the sky is falling? This is the true test of an investor. Think back to major market events. During the dot-com bubble of the late 1990s, Mr. Market was in a state of wild euphoria. He was offering to sell you shares in companies with no profits, no revenue, and sometimes no real product for billions of dollars. Speculators were making fortunes overnight. The intelligent investor, following Graham's principles, would have recognized this as madness and stayed away, even if it meant looking foolish for a little while. When that bubble burst in 2000, those who kept their discipline were safe. Conversely, during the financial crisis of 2008, Mr. Market was in the depths of despair. He was convinced the entire global financial system was collapsing. He was offering to sell shares in world-class, highly profitable companies for a fraction of their true worth. This was the time for the intelligent investor to act, to calmly step in and buy wonderful businesses at fire sale prices, protected by an enormous margin of safety. Those who had the courage and discipline to do so were richly rewarded in the years that followed. So, how do we apply all of this in the 21st century? Is a book from 1949 still relevant in a world of high-frequency trading, cryptocurrencies, and globalized instant information? The answer is, it's more relevant than ever. The technology and the investment products have changed, but human nature has not. The emotional cycle of fear and greed that drives Mr. Market is as powerful today as it was in Graham's time. The principles are timeless because they are based on business reality and human psychology. The defensive investor strategy is easier to implement now than ever before. Low-cost index funds and exchange-traded funds, or ETFs, allow you to own a broadly diversified portfolio of stocks for a tiny fee. This is the perfect modern tool for the defensive investor. It automatically provides diversification and forces a passive approach, protecting you from the temptation to constantly tinker and trade. For the enterprising investor, the world of information has opened up. Company financial reports are available at the click of a button, but the core task remains the same: sifting through that information to find businesses that are both excellent and undervalued. The noise is louder now, with financial news channels and social media amplifying Mr. Market's every mood swing, which makes Graham's call for emotional discipline even more crucial. The intelligent investor is not a get-rich-quick scheme. It won't give you hot stock tips. It won't tell you what the market is going to do next week or next year, because Graham knew that nobody can do that reliably. What it does is provide you with a durable intellectual framework and a sound emotional temperament for making investment decisions. It's a philosophy that grounds you in reality. You learn to differentiate between the price of a stock, which is what Mr. Market is shouting at you today, and the value of the underlying business, which is what you determine through careful analysis. You learn to use market volatility as an opportunity, not a threat. And you learn that the biggest risks in investing often come not from the stocks themselves, but from your own behavior. In the end, Graham's work is a guide to thinking for yourself. It empowers you to tune out the noise, to ignore the crowd, and to make rational decisions based on facts and analysis. It's not a map that shows you the exact path to wealth. It's a compass that always points you in the right direction, toward prudence, discipline, and a deep understanding of what you own. Following that compass is the surest way to navigate the often turbulent waters of the market and reach your financial goals safely.